Powell just dropped a bomb at Jackson Hole. Inflation is cooling, the economy's slowing, and interest rates? They're likely headed lower. And you know what that means? REITs. Yes, Singapore REITs could be about to shine again. But before I break it all down for you, do me a quick favor. Stay with me till the end of this video because I'll share which REITs and REIT ETFs could benefit the most, and how you as a Singapore income investor can ride this cycle safely. Also a big thank you. Our Wealth for You channel has grown from 0 to almost 4,000 subscribers, crossed 400,000 views, and hit nearly 30,000 watch hours. And we can only reach more Singaporeans with your help. Every time you like this video, YouTube pushes it out so more people here can get knowledge to improve their financial future. So please hit that like button, subscribe, and let's build a stronger Singapore income investing community together. Quick disclaimer, nothing in this video is financial advice. Everything shared here is for education and general information only, to help you understand REITs, ETFs, and income investing better. Always do your own research, consider your risk appetite, and if needed, speak to a licensed financial professional before making any investment decisions. Chapter 1. Big Picture on REITs. First things first. What exactly is a REIT? Think of it as owning a shopping mall, an office tower, or even a data center, without ever needing to fix the toilet when tenants complain. By law, REITs must pay out at least 90% of their rental income as dividends. That's why Singaporeans love them. It's like collecting steady rental income, but in a way that's liquid, diversified, and tax-free. Of course, there's a catch. REITs move in cycles with interest rates. When rates climb, REIT prices usually get hammered. But when rates fall, REITs often stage a strong rebound. And that's exactly why Powell's latest comments could be the turning point investors have been waiting for. Chapter 2. Why this matters for Singapore investors. Now let's bring the story back home to Singapore. Our economy is still humming along. Singapore's GDP grew 4.4% year-on-year in the second quarter of 2025, showing we're in pretty good shape. Inflation? Practically flat. July's overall inflation was just 0.6%, with core inflation at 0.5%. That's one of the lowest levels we've seen in years. So yes, prices are stable. But here's where it gets interesting. T-bills, which many investors loved when yields were above 3% last year, have now dropped sharply. The latest 6-month T-bill came in at 1.59%, and the 1-year at 1.68%. In short, the risk-free option is no longer as rewarding. Meanwhile, many Singapore REITs are paying dividends around 5 to 6%, with some trading below their book value. That's like being able to pick up a shopping mall or an office tower at a discount, and still collect steady rental income while you wait. Of course, not every REIT is the same. Higher yields often mean higher risks, so you need to be selective. But the big picture is clear. In today's low-inflation, low T-bill world, Singapore REITs can be a pretty attractive option for income investors. Chapter 3. Spotlight on big REITs and ETFs. Alright, let's zoom in on the REITs that most Singaporeans know and follow. First up, CICT, CapitaLand Integrated Commercial Trust. This is the heavyweight champion, the biggest REIT in Singapore. If you've ever shopped at Plaza Singapura, Bugis Junction, or Raffles City, congratulations. You've indirectly experienced CICT's portfolio. It's like the heartbeat of local REIT investing. Then there's Ascendas REIT. Think of this as the workhorse of the REIT world. Business parks, industrial spaces, logistics hubs. Very resilient, because whether times are good or bad, companies still need places to operate. Next, Mapletree Logistics Trust, or MLT. These guys own warehouses across Asia, and they're riding the unstoppable wave of e-commerce. Every time you click Add to Cart, Somewhere an MLT warehouse is probably part of the process. And of course, Mapletree Industrial Trust, MIT. Their secret sauce? Data centers. With AI, cloud computing, and digital transformation everywhere, data centers are basically the factories of the future. MIT has carved out a strong niche here. Now maybe you don't want to pick individual REITs. No problem. That's where REIT ETFs come in. The Lion-Phillip S-REIT ETF is a favorite among local investors. It tracks the top 20 Singapore REITs, so you're instantly diversified across the giants. Then there's the Nikko AM Asia ex-Japan REIT ETF. This one gives you a wider spread. Not just Singapore REITs, but also exposure to regional players in places like Hong Kong and Australia. Think of it as a one-stop Asia REIT basket. If picking individual REITs is like ordering a la carte, then ETFs are like ordering chai fun. You don't need to fuss over every dish. Just pick one plate and you get a bit of everything. Chapter 4. How interest rates affect REITs. Now, here's the golden rule every REIT investor needs to know. REITs and interest rates move like a seesaw. When interest rates go up, REITs suffer. Why? Because they borrow money to buy properties, and higher rates mean higher costs. That squeezes profits, slows DPU growth, and prices usually dip. When interest rates come down, the opposite happens. Borrowing gets cheaper, payouts become easier to sustain, and suddenly investors find REITs more attractive than bonds or fixed deposits. Prices usually bounce. History has shown this pattern again and again. After a tough rate hike cycle, REITs often shine once the cutting cycle begins. And guess what? Powell just hinted that rate cuts are on the horizon. The market expects the Fed could start cutting as early as September, with rates potentially 1% lower by 2026. What does that mean for Singapore investors? It means REITs may finally get some breathing space. Borrowing costs could ease, yields will stand out more compared to safe instruments like T-bills, and the overall wind is starting to blow in REITs' favor. In simple terms, REIT investors might be heading into calmer, sunnier weather after a long storm. Chapter 5. Practical Tips for Singapore Income Investors. So, how should we as Singapore income investors approach REITs? Let's break it down into a few key principles. First, think long-term. REITs are not a flip for fast profits kind of investment. They're designed to be steady income machines. If you hold them for 5 to 10 years, you let the rental income and compounding do the heavy lifting. Second, diversify. Don't bet everything on one mall, one office tower, or one data center. Spread your risk across multiple REITs. If you don't want to pick and choose, you can use REIT ETFs or managed REIT portfolios that instantly give you a basket of properties. Third, reinvest your dividends. It sounds small, but reinvesting even that extra 0.5 to 1% every year compounds into a huge difference over decades. That's how wealth quietly grows in the background. Fourth, don't be blinded by high yields. A REIT paying 9% looks tempting, but if it's over-leveraged or struggling with falling rentals, your capital might take a hit. Instead, focus on strong management teams and consistent DPU growth. Finally, keep balance in your portfolio. For most income investors, REITs can take up maybe 30 to 40% of your strategy. The rest can sit in CPF, bonds, or dividend stocks, giving you both stability and flexibility. Now, let me give you a simple copy analogy. Think of your portfolio like your copy order. CPF is like kopi o kosong, plain, steady, no surprises. REITs are like kopi with condensed milk. They sweeten your returns with juicy dividends. But drink too much condensed milk kopi and you'll feel jelak. Same with REITs. Too much exposure can weigh you down. Balance, as always, is the secret recipe. Final thoughts. So here's the bottom line. With Powell hinting at rate cuts, the tide may finally be turning for REITs. And if history is any guide, that's when the sector often shines. Big names like CICT, Ascendas, Mapletree Logistics, and Mapletree Industrial Trust, plus ETFs like the Lion-Phillip S-REIT ETF and Nikko AM Asia ex-Japan REIT ETF, give you solid diversified ways to ride this next wave. Always remember, REITs are about being cash flow rich, not paper rich. Collect your dividends, reinvest them, and let time and compounding quietly build your wealth. That's how you turn steady rental income into financial freedom. If you found this breakdown useful, do me a favor. Hit that like button so more Singaporeans can learn about income investing. And don't forget to subscribe to Wealth for You for more deep dives on CPF, REITs, and dividend strategies. The channel has grown to almost 4,000 subscribers, over 400,000 views, and nearly 30,000 watch hours. And it's all thanks to your support. With your help, we can reach even more Singaporeans and give more people the knowledge to improve their financial future. So don't miss the REIT boat this time. The winds are shifting, and this could be your chance to sail with them.